and welcome to a special show on ET Now called Smart Spends. This Diwali, I believe all of us at some point will realize the importance of saving money and perhaps chopping down on expenses. But sometimes we don't recognize the need at a very early stage. So, at this time, we want to ensure that your wallet is never empty and that you put your money in all the right places. In fact, no matter how much money you have, spending it wisely is always a good idea as it helps you get the most bang for your buck. Today on the show, we have experts joining in across sectors to talk about how you can spend your money wisely. From real estate, Ramesh Nair, CEO and country head JLL India, joins in. We also talk about the importance of personal finance with Gaurav Mushruwala, financial planner and author of Yogic Wealth, and give you the importance of investing in commodities like gold. Sanjeev Agrawal, CEO, Gitanjali Expert with us. Gentlemen, lovely to have you with us. I'm going to kickstart the show by talking about renting or buying because that is really the question when it comes to real estate. Ramesh, I'm going to start off with you. When it comes to the big question here, the capital gains from appreciation in home prices versus rental income is a big question mark. Clear the air, clear the doubts and tell us what would be your advice when it comes to spending wisely, renting or buying in the current market that we're in?
See, when one looks at real estate, it's very important that you look at it from a 5 to 10 year period. So you should never look at real estate from a 6 months or a 1 year period. So let's look at what's been happening in the market since 2004. From 2004 to 2008, we saw the prices go up by nearly 225%. In 2008-9, the prices came down by around 12 to 15%. And since then, most markets like Mumbai has gone up by 90% since then. Pune has gone up by 100%. NCR and Bangalore have gone up between 50 to 60%. And what we have seen over the last 9 months to 12 months is prices actually dropping a little bit. We have seen a correction of around 7 to 8% across the real estate market in India.
Ramesh, I want to talk about another thing where investors or, the general public tends to burn their fingers, and that's investing money in under construction projects. What tends to happen is that sometimes they never really see the light of the day. What is your advice when it comes to investing in some of these under construction projects? Is it a complete no-no?
So when you're looking at under construction, look for projects which have had some amount of completion, at least where the project is halfway through. Look for projects which have been done by credible developers who have a long track record. Look for if the project has financial closure. And today with things like RERA becoming a reality, I think it's a good time to look at all approvals if the developer has everything on track and also look at what percentage of the apartments he is sold.
That would be important. Now, Ramesh, you touched upon some of the storms really that the real estate sector has weathered, be it GST or demonetization. On account of that, in your experience, if you could just break it up for us region-wise, where it would be advisable, where you're seeing some sort of a price correction, or what the outlook is really generally when it comes to the trends in prices city-wise or region-wise.
See, my outlook for an India-wide level, I don't see prices considerably going up in the next year or so, but we also don't expect prices to go down. Why I believe prices are not going to go down is because there's massive drop in new launches. What we have seen post demonetization, new launches are down nearly 55% all over India. And last year, again 2016 compared to 2015, we saw launches drop 35% across the country. So with no new supply coming in, obviously the existing supply will kind of over a period of time kind of get sold. What we have seen over the last 6 quarters is all 6 quarters sales has been more than launches.
Talk about Mumbai in specific, Ramesh, it's one of the costliest cities to buy or to rent a house in currently. With REITs coming in, with RERA, etc., what is your outlook on the scenario when it comes to Mumbai property prices?
We did an analysis of all the projects which have been registered under RERA in Mumbai. And what we realized is out of all these projects which are under construction, 66% of it is not sold and 33% of it is already sold. So we have a good amount of inventory which is under construction, which is available. A trend which we have actually seen post in the last 2-3 years is projects typically get sold in the last a lot of apartments, around 15 to 30% of the apartments are sold in the last 6 months of project completion. And what we've also seen is in Mumbai, the average sizes have dropped by around 21% in the city over the last 4-5 years. So 1000 square feet apartments have today become 800 square feet apartments. So these are some of the trends which we are seeing.
I'm glad you said that right now as well, because we tend to get a lot of questions and queries as well about whether or not they should, investors should put their money in renting or in buying. So I just want to, for someone who has a long-term time frame, has a decent amount of capital at hand, what is your final assessment as to what they should do when it comes to parking their money either in buying a new property or rental?
I would definitely say this is a great time to buy, mainly because real estate, like every other asset class, has its cycles. And we have seen the cycle the last 3 years. We haven't seen too much of capital appreciation. There have been corrections. Whatever supply which is there is slowly getting absorbed and sold. So from a buying perspective, I think the timing is good because we don't see too much of fresh new supply coming. And also from a buyer's perspective, today you look at it, you have acts like RERA to protect the buyer. So that's the time the buyer needs to get more confidence so that he can go ahead and take that buying decision.
Let's talk about some of the trends, Ramesh, before we let you go in real estate. You believe that industry consolidation amongst players is going to be on the cards?
So 3-4 trends which are quite visible in the last few months. Firstly, definitely more transparency, leading to more accountability. RERA has definitely been a game changer on that. Second is huge amount of consolidation. Many large developers are partnering with small developers. Many small developers are asking themselves, should I be doing 10 projects at the same time, or should I just be doing 2-3 projects and partner on the balance? Many developers today are looking for alternate sources of capital. The third big trend which we are seeing is the return of end users. All the buyers today, most of the buyers today in the market are end users. You're not seeing speculators and investors come in a big way. Gone are those days where people could expect 20-25% capital appreciation. So that's obviously keeping the speculators and investors away. So these are broadly the key trends which you've seen in the market.
So there you have it. That's the advice coming in on real estate, what exactly an investor should do. It's a prudent time, says Ramesh right now, to put your money and buy a property. Hope we've cleared the air for you there. Well, let's shift gears from real estate, talk about personal finance. So many asset classes, but when it comes to mutual funds, fixed deposit, what's the right way to go in order to make sure that you capitalize on your returns? Joining in to guide us through this is Gaurav Mushruwala. He's financial planner and author of Yogic Wealth. Thank you so much, Gaurav, for being with us. I'm going to start off with the basics. It's the festive season. What's really your guide on how one should be looking at investing?
Well, whether it's festive season or anything else, my answer or any financial planner's answer is look at your financial goals. If you're likely to save for an event which is going to come in next 2 to 3 years, then you want to choose debt as an asset class. There could be any vehicle. If it's greater than 7 to 9 years, equity as an asset class. Again, the vehicle could be direct equity, equity mutual fund. For an interim period, make a combination. So look at your own requirement and choose, because our goals are not dependent on what's going to happen next. I mean, whether my son or if my son or daughter is going to go for higher education, I'm not going to go and tell him or her that just because market has gone down, defer your education, or because it's gone up, you go ahead and pay all 4 years fees upfront. So my funds requirement don't change based on external condition. The investor should choose an asset class and then an appropriate vehicle based on their financial requirement and financial goals.
Okay, now I know it's not an apples to apples comparison, but two avenues that are safe for investing would be mutual funds as well as fixed deposit. Gaurav, I want to understand your view as to how you would look at these two avenues individually and what would be prudent for someone who's sitting on a large corpus to put their money in if they're a bit risk averse.
So number one, nobody invests in mutual funds ever. We only invest through mutual fund. Mutual fund is a vehicle and it's not an asset class. So through mutual fund, we can invest in either equity, or through mutual fund, we can invest in gold, or through mutual fund we can invest in debt based instruments which are bond and debentures or combination. Fixed deposit is a pure debt based instrument. Somebody who has a financial goal coming up in next 2 to 3 years, somebody who's seeking safety of capital, somebody who wants regular income, fixed deposit is an option. Somebody who's looking at saying that, look, I have a long term goal, obviously equity mutual funds is an option. Debt mutual fund also are kind of an instrument which can serve your goal for reaching near term targets. But one has to keep in mind that returns from debt mutual funds are not assured. They can go up and down based on the interest rate environment.
Okay. Now I'm sure everyone wants to know this advice, Gaurav. When it comes to putting your money really in a mutual fund, what guidelines or what advice would you have on how to choose a mutual fund?
So I've already said in first two answers, decide your goal. So that's the first step because that will help you choose what kind of scheme, whether equity, debt, gold or combination. So that's the first step. Then comes the second step. Once you have decided the asset class, then it comes to choosing of schemes. Now that's where the real difficulties begin because more than 3000 schemes, so many mutual fund companies. So let's say if you have chosen an equity fund, now within that also we have a lot of funds and schemes being launched, though SEBI is trying to consolidate, and we will see SEBI is putting a guideline to consolidate, and then we will see a lot of consolidation. But till that time, look at certain parameters. There is no single parameter, but couple of parameters that should be looked into is number one, how many years the scheme has been in existence, how many business cycles that scheme has seen. More the business cycles the scheme has seen, better it is. Second is look at expense ratio. Lesser the expense ratio, better off you are. Third, what you want to do is look at the returns, but compare these returns with the benchmark, which means pick up the SID or for a layman, pick up the offer document, which will say against which benchmark the scheme is being compared, and then you will get information as to how is its performance vis-a-vis the benchmarks.
Just to stretch that point forward, in your experience, I'm sure you've seen a lot of investors get their fingers burnt, maybe when it comes to timing or not adhering to the right rules and regulations. What are the specific, I know you spoke about identifying the financial goals, but some of the other don'ts or do's that you would advise when it comes to putting your money in mutual funds?
Well, couple of things. One is don't follow the herd, because that's what happens, and this happens because people have not decided their goals, which is internal condition. So first is don't follow the herds, was one most important thing. Second important thing is don't churn. So don't keep moving in and out of funds. There was a legendary fund manager, Peter Lynch, in New York. His fund performed very well, but when he retired, he said, my fund has performed well, but the investors have not. And this happened because investors kept moving in and out of fund. They didn't benefit, the fund gave good returns. So your fund managers anyway thinking of how you should change the portfolio, you don't do it. That's number two. Third is don't have too many schemes. I've seen portfolios where there'll be some 10 equity schemes, 7 debt schemes. That's not helping you. So many times the underlying scripts, the underlying investments are same. So don't have too many schemes. Don't spread yourself too thin. These are certain mistakes which people make, which is detrimental to their own financial health. So stay away from that. Simple steps, basic steps will see your wealth growing.
All right, we'll leave it. We'll be content with the advice that you've given us for now. So thank you so much for joining in, Gaurav, and giving us your views on personal finance and how one should really explore to put their money within various asset classes. Time to slip into a quick break right here on Smart Spends, but I'm sure that everyone would like to know the outlook on gold in prices. Is it better to invest in physical gold or gold ETFs? We have Sanjeev Agrawal, CEO, Gitanjali Export, joining in on the other side to give us his views. Welcome back. Still tuned into Smart Spend. So we've dissected real estate as a sector as well as personal finance. But now let's focus on the glitter in gold and whether the sheen is currently there. Joining in to discuss the benefits of investing in physical gold versus gold ETFs and what is the outlook on gold prices, I have a veteran from this space, Mr. Sanjeev Agrawal. He's the CEO of Gitanjali Export Corporation, now joining in. Mr. Agrawal, thanks so much for being with us now. I'm just taking a look at data of the spot gold price movement and in the last 5 years, gold has been down about 27% and in the last 10 years has been up 75%, whereas when it comes to gold ETFs, in the last 5 years, it's been down 29% and in the last 10 years, up about 66%. Based on the kind of data at hand and your experience, what are the benefits of investing in gold versus gold ETFs?
Sure. First of all, let me greet your viewers a golden Diwali and a prosperous New Year. There are various options traditionally to invest in gold, starting from physical gold bars and coins. Then there is the evolution of ETFs, which came up a few years back. Roughly about 10 years back, it became very popular. And the most recent product that is available in the market, launched by the Indian government itself, is the sovereign gold bonds. And amongst all these products, the best option definitely is the sovereign gold bonds, because of the fact that not only do you get the benefit of inflation protection, upside of gold price movement, but also the fact that you're getting interest at 2.5%. Whenever you sell it at maturity or prematurely, there's no capital gains tax. The interest is tax-free. So all this put together, there are numerous options today for a buyer who's looking at gold as an investment.
So what exactly is the procedure to go about choosing these two ways of investing according to you?
The choice of the various options would be depending on what is your final objective. If you're looking at an objective where you want to make a family member happy, see the smile on the face of your wife or brother or sister or your mother, you will be gifting gold coins, which is available from the local jeweler. There are different types of coins available for different occasions. So the gold coin is the easiest option available today. If you're looking at an investment where you're talking about savings for a longer term duration, where you need the funds maybe 5 years, 7 years, 8 years later for the future, then obviously the best option is the sovereign gold bonds. The sovereign gold bonds from the government of India it has been available in specific tranches issued by the Reserve Bank of India, and going forward they have taken inputs from people like us at FICCI and other trade members, and they are going to make it available on tap. So that makes it more convenient. Otherwise, it's only available for certain windows, or you could buy it from the secondary market. It has certain catch in terms of having a demat account. So the scope today for investing in a sovereign gold bond remains limited. But going forward, I'm sure they're going to make liberalize many other areas. So the range is wide, starting from a coin where you can get instant gratification to a sovereign bond, which is a longer term duration. And in between, there are a few apps which are also giving you a gold accumulation plan. So these applications available on various platforms are also giving you an opportunity to invest in gold. So the market is evolving a lot, and the scenario can be very, very competitive and very interesting for the investor going forward.
So the question I want to really nail it down to is, do you think that now physical gold is losing its sheen? You know, it's not easy as an asset to accumulate, to store. That's just one of the negatives. But as an asset of physical gold, where do you see prices headed? And do you think that gold is now losing its sheen, physical gold?
If you look at the figures, traditionally in India, physical bars and coins, over 300 plus tons of physical bars and coins were being bought every year. That's significant market. The banks itself up to 2013 were selling about 35 to 40 tons. Now, let me tell you, this when I'm talking about physical bars and coins, I'm not talking about cash transactions per se. It is legit money which a person is investing in these bars and coins, because that was the only method available. The gold ETFs were available, but today with the sovereign gold bonds, they have lost their charm somewhat, because of the fact that when I buy a ETF in gold, I am paying a management fee to the mutual fund, and I don't earn anything. Whereas a sovereign gold bond gives you interest at 2.5%, like I said, but then liquidity is available much more in the ETF versus a sovereign gold bond. So there are various reasons why you buy the 3 options or the 4 options with the apps also coming on board. It all depends on what is your final objective.
So what kind of returns then can investors expect when it comes to investing in both these avenues individually? What do you think?
See, traditionally, when you're investing in gold, a lot of empirical data shows that of your investment portfolio, you should have between 15% or thereabouts in gold, in addition to your stocks and bonds and fixed income investments. And the primary objective of the gold holding is not necessarily a return, but a safety net, a sort of a buffer against the volatility of your equity portfolio. The other advantage of gold from an Indian perspective, from an Indian investor perspective, is the fact that today for an Indian, the only way to protect your rupee depreciation and currency risk, as a financial planner would put it, is buying gold, because gold is akin to buying foreign currency or US dollar. So typically for an international investor, a fund manager or a advisor would say, park some of your money in US dollars, park some of your money in maybe New Zealand dollars or Aussie dollars, to make a basket of currency and investments. From an Indian perspective, that's not available, and that's where the gold comes in to play a natural hedge against the rupee currency.
Right, point taken. But what do you think would be the differences between the transaction cost of investing in physical gold versus investing in gold ETFs? Is it very drastic?
Obviously, when you're buying physical gold, because there is a making charges involved, there's a packaging cost involved, there is a cost that the seller incurs in terms of interest of holding that stocks for you. So when you're buying coins, depending on who you're buying it, the markup on the gold price could be anywhere between about 2% to 4%. There are some companies which are even selling it at a markup of 6 to 8%. When you're buying an ETF, there's not really much of a charge, but like I said, you're paying a management fee of roughly about 2% every year. When you're buying a sovereign gold bond, there's no fees whatsoever, and you get a 2.5%. So the variations are huge. There's a cost attached to a physical to buy, roughly about 2%, but there's no management fee as such. When you're buying an ETF, there's a 2% or thereabouts management fee and a buy-sell bid-offer spread. And when it's a sovereign gold bond, you're earning 2.5%, but then liquidity is not available. So that's the options available.
So finally, before we let you go, your view on where gold prices are headed, and what do you think is more convenient for an investor to put their money in? Would it be physical gold or gold ETFs?
Well, definitely physical gold is the easiest, because not only can you get them in denomination of 1 gram, going up to 100 gram or 1 kilo, so the variations are huge. The most advantage thing about the physical gold bars and coins, and why they've been there for generations in the Indian ecosystem, is the convenience. That's the only currency or investment that you can in cash 24/7. You have a problem, somebody's hospitalized, injured, at 12 at night, you can go to somebody and sell your coin and get cash. That liquidity, no other paper instrument can provide you. So that's a huge advantage.
Okay, we'll let you go on that. No, thanks very much for giving us more assessment and advice on what one can look at when it comes to investing in gold, as well as all of the new avenues. And with that, gentlemen, it's been lovely having you with us today on Smart Spends, and I hope to all of our viewers, we've given you better ways of taking control of your finances, some of the classic mistakes that people make when it comes to investing, and how you can maximize your returns. Thanks so much for watching, and here's wishing you a prosperous and a happy Diwali.